Welcome back to our channel where we discuss personal finance topics related to stock market investing. Stock splits and reverse splits are significant events in the life of a publicly traded company and can impact investors in various ways. Understanding these corporate actions is essential for both new and seasoned investors. This video will delve into what stock and reverse splits are, why companies undertake them, and their implications for investors. Understanding stock splits. A stock split is a corporate action where a company divides its existing shares into multiple shares. For instance, in a 2-for-1 split, a shareholder who owned one share will now own 2 shares. Despite the increase in the number of shares, the total value of the shares held by the investor remains the same because the split does not change the company's market capitalization. Reasons for stock splits. Improving liquidity. Stock splits make shares more affordable to small investors by reducing the price per share. This can increase the stock's liquidity, meaning the shares can be bought and sold more easily. Psychological appeal. Lower-priced shares may appear more attractive to investors, potentially increasing demand. Signaling confidence. A stock split can be perceived as a signal that the company's management is confident in the business's future prospects. Implications for investors. No direct financial benefit. While the number of shares increases, the total value of your investment remains the same immediately after the split. Potential for long-term gains. If the split leads to increased market interest and higher demand for the stock, it could potentially increase in value over the long term. Understanding reverse stock splits. A reverse stock split is the opposite of a stock split. In this scenario, a company reduces the number of its outstanding shares, and the price of each share increases proportionally. For example, in a 1-for-10 reverse split, an investor holding 10 shares valued at 110 each will end up with 1 share valued at 10 yuan. Reasons for reverse splits. Boosting share price. Companies often undertake reverse splits to increase their share price, especially if it has fallen to deficient levels. Meeting listing requirements. Stock exchanges have minimum share price requirements. A reverse split can help a company comply with these rules. Improving perception. Higher-priced shares may be perceived as more valuable or stable by the market. Implications for investors. Immediate impact on shareholding. The investor owns fewer shares post-reverse split, but the total value of their holding remains the same, barring market reactions. Possible negative perception. Reverse splits can sometimes be perceived negatively, as they may indicate that the company is in distress. Market reaction to splits and reverse splits. The market's reaction to a stock split or reverse split can vary. A stock split may be perceived positively and lead to a short-term increase in the stock's price. On the other hand, a reverse split may initially be viewed negatively, as it could signal that the company is facing challenges. Long-term implications. For long-term investors, the fundamental value of the company is more important than the number of shares or the share price. The focus should be on the company's performance, market position, and prospects rather than on the mechanical effects of a stock or reverse split. What should investors do? Research. Understand the reasons behind the company's decision to split or reverse split. Analyse fundamentals. Evaluate the company's overall financial health and prospects. Consult financial advisors. If uncertain, seek advice from financial experts. In conclusion, stock splits and reverse splits are important events that investors should understand. While they don't change the intrinsic value of the company, they can have implications for market perception and stock liquidity. As an investor, it's crucial to look beyond the split and focus on the company's fundamental health and long-term growth potential. Whether you're a beginner or a seasoned investor, understanding the nuances of stock market activities like splits and reverse splits is vital in making informed investment decisions. If you enjoyed this video, please like it and subscribe to our channel.